Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Shiraz Mia, Zacks Director of Research and a former oil analyst. So we're talking about the energy sector today, energy stocks and ETFs. Shiraz, welcome back. Great to have you on the show.
Oh, it's a pleasure to be with you, Neena.
So energy was the best performing sector last year, and it remains the best performing sector this year as well. But it seems that the rally has taken a breather over the past month or so. In fact, the sector is down over the past month. And we know that energy stocks are usually highly correlated to movements in oil prices. And oil prices had surged to over $120 a barrel earlier this month. And we know that high oil prices have been largely responsible for inflation around the world. Now, last week, oil prices fell to around $104 a barrel. And that was mainly due to concerns regarding global economic slowdown. Now, they have risen again this week. So there's a lot happening, which impacts oil prices. So tell us about these recent moves in oil prices, what is happening in this space.
So there's a lot of cross currents, as you know, Neena, that drives oil prices. So the Russia-Ukraine situation is one big factor that has been weighing on the supply side of the equation. And then on the flip side, on the demand side, there are these economic forces. As you know, oil is a very economically sensitive commodity. The Fed is raising rates here. Other global central banks are also broadly in a tightening cycle. Relatively not as aggressive as the Fed, but overall the posture is towards tightening. And the goal here for all of these central banks is to take the edge off consumption and demand, meaning economic growth in the US, in Europe, and globally to come down to some extent, so that inflation comes down. Now, if the outlook for the economy is weakening, then the outlook for consumption is also expected to weaken. And it's this interplay of forces that is really at play in what's happening to oil prices. And on top of that, there's the uncertainty about China, whether they are opening up or locking down, and what effect that has on Chinese crude oil demand, the second biggest user of crude after the US. So all of these forces are at play. In my judgment, the easy gains in the commodity and as a result in the stocks have been made, and we are in for a bumpy ride over the coming months.
So you're right. There's a lot of uncertainty. And as you mentioned, these global central banks, including the Fed, they are trying to curtail the demand side of the equation. And there's a lot of uncertainty on the supply side too. And the central banks cannot do anything about that. And we know that President Biden is planning to go to Saudi Arabia next month, and he's expected to ask for an increase in oil production. But there are questions whether Saudi Arabia and UAE, two major oil producers, whether they actually have enough spare capacity to raise production. And then we saw these announcements by G7 that they are exploring price caps on Russian oil. And there's some talks about the possibility of Iran bringing 1 million to 1.5 million barrels of oil to the market if sanctions on Iranian oil are eased. So taking into account all those possible factors in play, where do you see oil in the coming months? Do you think that it will stay close to $100 a barrel, or do you expect it to go up during the summer months?
I think it'll bounce around the current level, Nina, till we get clarity on both of those sides of the equation. And what I mean by that is about the demand side, which will be a function of the economic outlook, and then the supply side, which will be a function of all these factors that you mentioned. Does the Saudis and the UAE have the ability to pump more? Can Iran be brought back to supply more? So as the market grapples with the interplay of these forces, I think oil prices will be bouncing around here without getting a clear directional nudge, higher or lower. Though my own sense is that we'll get more clarity on the demand side sooner, by the end of the summer months at least, with data here in the U.S. as well as in other OECD economies. If we see GDP growth and the outlook for consumption start easing, I think that should have a favorable impact on oil prices, favorable from a consumer standpoint, not from the standpoint of oil company investors or oil stock investors. It could be a bearish, near-term bearish trend for oil stock investors.
Okay, so talking about the production here in the U.S., so we know that surging gas prices are one of the biggest concerns for consumers in the U.S. And President Biden believes that oil companies like Exxon, Chevron, other oil producers, they are partly responsible for these high fuel costs in the U.S. And he said that these companies should increase production and expand refining capacity. In fact, he said that Exxon made more money than God this year, and he's not able to understand why they are not expanding production and refining capacity. But actually, expanding production and refining capacity is not that easy. So could you explain to our listener why that is not so easy?
Yeah, no, you're absolutely right. It's not very easy. In fact, over the last many years, these companies had been dealing with low commodity prices, and as a result, the balance sheets for most of the energy sector companies were really stretched thin. A number of companies went out of business a few years back. This is, in fact, the first time in many, many years that these companies are really over-earning and as a result in a position to reward their investors, their shareholders, repair their balance sheets, and rewarding the shareholders through dividend hikes, through improved share prices. But in terms of investments, the capital market has not been supportive of these companies investing in capacity, whether that's on the drilling and production side or on the refining and marketing side. On top of the capital markets restraints, there's a bunch of regulatory issues as well that come in the way of these companies responding as promptly as the president would like them to do. As you know, carbon footprint and investing in renewables has been official government policy both in the U.S. and elsewhere. And the policy regime in place has not really been favorable to these companies, these companies investing, and in the capital markets supporting them in investing in these activities. My own sense on these questions, Nina, is that the spike in oil prices that we are going through right now is a wake-up call for policymakers in the U.S. as well as elsewhere, that while it's desirable to encourage and invest in renewables, we have to simultaneously encourage and invest in hydrocarbons and fossil fuels. That's obviously a more expensive route for policymakers, but this experience shows us that there's no alternative to that. We eventually would like to reach a phase where fossil fuels are an ever smaller proportion of the fuel mix, but we're nowhere near that end goal. And in the meantime, societies will need to invest and will need to set up the infrastructures in terms of the policy packages to encourage the likes of Chevrons and Exxons and not browbeat them as what the president was doing in those comments that decided.
Right. So the war in particular has really exposed how reliant we are on the fossil fuels, because we all believe in climate change and we want the transition to net zero to accelerate in the coming years. But the fact is that on the supply side, we do not have enough alternative energy solutions. So you talked about capital market restraints, you talked about regulatory issues, and these big asset managers, they have been pressuring these companies to reduce investments in production and instead return more money to their shareholders. So do you think we will see some sort of a resurgence of investment in fossil fuel production in the coming years in the wake of the war, and particularly if oil prices stay high?
I think we will. Yeah. So the normal course of any commodity market is that that high prices not only causes demand to come down through for example, high gasoline prices, but also incentivizes producers to produce more. And it has been relatively slower than would be otherwise the case. But I have no reason to think that over the coming years, companies will invest in more fossil fuels and in greater hydrocarbon production. But the issue of regulatory support and public policy support still remains. I think the OECD economies, US and Europe, they'll have to realize that the goal of zero emissions and carbon neutrality and a greater share, ever greater share of renewables in the energy mix, as desirable as that is, we have to live for a very long time with fossil fuels. And if we don't invest and if we don't encourage investment in fossil fuels, then we have to ready with to live with the pain of higher fuel costs. And even if the U.S. economy slows down and the global economy slows down, and that takes the edge off the current demand pattern, say later this year and into next year, we know that eventually growth will resume. And once growth resumes, we will be back to square one where we are at present in terms of oil prices and the demand for oil. And if we don't plan for that, we will be in the same spot in a couple of years from now.
Right. So we all know that climate change is real, and we have seen some devastating effects of global warming. So now, if the world starts to invest again in fossil fuels, then what all that is going to mean for the goal of transition to net zero by 2050. And we know that some of these oil giants also are increasing their investments in cleaner sources of energy. They are also investing in carbon capture technologies. They have some goals to reduce emissions from their own operations. But what do you think will happen to this goal of transition to net zero by 2050?
I think the current phase of high fuel costs will cause a more balanced approach, a more grounded and more humble approach to how that long-term goal has to come about. As I mentioned and keep pointing out, climate change is for real. Hydrocarbons eventually have to be phased out, or we have to develop technologies that are helping us capture the consumed and burned carbon. So it has to be an all-of-the-above type of approach where, while we are investing for renewables, we are not ignoring investments in hydrocarbons, and we have to be flexible in our long-term goals. And I'm not just suggesting the U.S., but globally, this is an important and major issue. And the current spike in oil prices I hope it has made policymakers realize that there is no easy and cheap way of getting to a carbon-free future. The path to that future is difficult and expensive and requires investments in fossil fuels and hydrocarbons as well.
Right, a balanced approach or humble approach that you mentioned.
That's
that
right.
makes a lot of sense. Now, I wanted to talk about energy stocks, but before that, I wanted to talk about earnings picture for the energy sector, because I know that you track earnings very closely. So tell us what analysts expect for earnings from these energy companies in this quarter.
It's a very, very impressive earnings picture, Nina, as you can imagine, for the June quarter, which is just getting underway. The expectation is for 189% earnings growth and almost 37% revenue growth. The picture annually is equally impressive. In fact, the revisions trend for the energy sector is so unprecedented and so positive that it's causing the negative revisions in a host of other sectors, including technology and finance, to be hidden in some respects when we and when the market and when the analysts are looking at the aggregate picture, like say for the S&P 500. So if we look at earnings for 2022 as a whole, for example, they have gone up slightly since the beginning of the year. And a big reason for that is the very strong positive revisions to the energy sector. So a very, very robust and positive earnings and cash flow outlook for the energy space.
Wow, that's very impressive. So do you think investors should take advantage of this slight dip in energy stocks to add to their energy exposure? And when we had you on the show last year, you had emphasized that investors had very little exposure to energy because energy had become such a small part of the broader indexes. And despite the outperformance last year and this year, energy is still less than 5% of the S&P 500 index. So most investors, they have a lot of these broad plain vanilla ETFs and mutual funds like SPY or VOO in their portfolios, these ETFs and mutual funds which track the broad indexes like the S&P 500 index. So investors are still underexposed to energy. So do you think this is a good time to add their exposure to the energy sector? And if yes, which are your favorite stocks, energy stocks that investors could look at?
So let me take up the first question about whether they should invest or not. I think they should, assuming they have a long-term outlook. Tactically speaking, if they are using it for trading activity, I think it could be very volatile for the next 3 to 4 months, as we discussed earlier. Because the outlook for the underlying commodity is so uncertain. But if they can hold on to these stocks for the next couple of years, say, then I think I'm reasonably confident that they'll come out ahead. And for those long-term investors, even if the economy goes down significantly, even if we get into an economic downturn, these stocks obviously will go down with that. But there can be a strong certainty that at the other end of the downturn, these stocks and the commodity will be bouncing back. As we discussed, the supply-demand dynamic, the long-term supply-demand dynamic for the commodity and these stocks is very, very favorable. Now, that said, I personally prefer the large caps for exposure to the sector. Obviously, investors can have a variety of ways in which they can gain exposure to the sector. I like the super majors, Exxon and Chevron. Of those two, my personal favorite is Chevron. It's a relatively, between the two, Chevron is relatively oilier. It moves a little more with oil price movement, and that's a reason why it has pulled back a little more than Exxon has. On the relatively riskier side of the equation, I would prefer if the investors, if your listeners have more risk tolerance and more ability to withstand volatility, then an exploration and production company would be a better candidate for them. My personal favorite on the E&P side is Pioneer Natural Resources, PXD. But there's a variety of other high-quality E&P players as well. We touched on the outlook for production in the U.S. and globally, and a high beta and relatively volatile as the E&P companies. You could have Halliburton and Schlumberger. Halliburton is HAL, Schlumberger is SLB. My personal favorite is Halliburton. It is more geared to North American shale-centric activity. And I think the long-term outlook for that activity is very strong. Schlumberger has a fair amount of North American exposure too, but it's more global, has a fair amount of OPEC and non-OPEC international exposure too. I believe the outlook for North American shale activity beyond the next year or so is a lot stronger than the international outlook.
Excellent picks, Shiraz. And thanks so much for joining us today and sharing your insights.
Always my pleasure, Nina.
So that was Shiraz Mia, Zac's Director of Research. Let's quickly summarize stock tickers that he mentioned. He talked about Chevron, ticker symbol CVX, Exxon, ticker symbol XOM, Pioneer Natural Resources, ticker symbol PXT, Halliburton, HAL, and Schlumberger, ticker symbol SLB. Now, if you want to look at oil and energy ETFs, the most popular oil ETF, which is the United States Oil Fund, ticker symbol USO, that and other oil funds, oil ETFs, they use various futures strategies to track oil prices, and they could be good at tracking the commodity prices in the short term, but they could perform much worse than the commodity in the longer term due to contango issues. And oil prices are expected to be quite volatile in the coming months, as Shiraz mentioned. So these oil ETFs are good, suitable only for short-term traders. They are not good for long-term investors. If you are a long-term investor and you want to increase your exposure to the energy sector now or in future, whenever you see a proper opportunity or to buy on dip, then you could look at ETFs that hold energy companies rather than futures. And there are two very good ETFs, excellent ETFs. This one by State Street, XLE. It is the Energy Select Sector Spider Fund. And this one by Vanguard Energy ETF, ticker symbol VDE. Both these are market cap weighted, very, very cheap, just 10 basis points expense ratio. So they are suitable for long-term investors. If you want to focus on exploration and production companies, and if you don't want a very top-heavy ETF, both XLE and VDE are very top heavy, with the two companies, Exxon and Chevron, accounting for a large portion of the portfolio. So if you want to avoid that and focus on exploration and production companies, then you could look at the SPDR S&P Oil and Gas Exploration and Production ETF. Ticker symbol is XOP. This is an equal weighted ETF. So this tilts away from the oil giants and more towards small and mid-cap oil E&P companies. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.